Hello, everyone. Welcome to the stock-specific class here for Thursday, April the 1st. I got to apologize ahead of time. I'm dealing with a little bit of a migraine, and it's kind of right at the point where it's either going to start to get a little bit better or get a lot worse. So I might just have kind of a brief update this afternoon. Hopefully that's okay with everyone. But I do want to point out a couple of key things as far as the charts, and we'll look at some individual stocks. And then the training today is going to be on protective puts, kind of wrapping up the options, talking about options and how to use options. We'll learn how you can use put options to protect your stock portfolio, kind of like insurance for your stocks. But I'll go over the strategy around that and kind of what you have to be aware of and what the choices that you're making when you decide whether or not to use that strategy. As far as the markets are concerned, the direction alerts are pretty much not much has changed since what I talked about on Tuesday. So if you went back and reviewed the market update on Tuesday, you'll get the bulk of that analysis. But I do want to go straight to the charts here and point out a couple things. On the S&P 500, it looks like we're going to be closing at a new all-time high. We were kind of breaking out today. Yesterday it got close, but it kind of backed off at the end of the day. Now the Dow already had closed at a new all-time high, barely, all-time closing high right here. It's been kind of moving a little bit sideways the last few trading days. Now, as you hear me talk about a lot, whenever you see that moving sideways, you want to pay attention to the direction it was moving in before it moves sideways, because that's where it's more likely to go after it's done moving sideways. So it does look like in the near term, we probably have another day or two where we can move higher. But I'm going to show you what I'm a little bit concerned about as far as we'll have to kind of pay attention to next week as to how much further we might rally. And one thing I've been talking about a lot is that I'm expecting a little bit bigger sell-off to take place at some point because of the fact that the NASDAQ 100 chart has kind of broken its longer-term trend line and go all the way back here. Kind of broke through that. It's kind of coming back up, and it's kind of retesting that line. Same with the Russell 2000. So the Russell 2000 and the NASDAQ 100 have both kind of broken their uptrend lines. I know that's not a straight line there, but not only did it kind of break that longer trend line there, but it also almost moved to a lower low. And so I'm looking at this rally on both the NASDAQ and the Russell 2000 as just kind of that final attempt to rally back up, possibly creating a kind of a bearish head and shoulders pattern, and then maybe a bigger sell-off. Now, again, one thing that I always talk about too, and I've said it a few times over the last few updates, no analysis we can do can tell you exactly what's going to happen. All I'm pointing out is some of the warning signs that we're starting to see. I'm not trying to bad talk the market or talk the market down. It's just, as a trend trader, you want to be able to recognize when the trend looks strong and when it looks weak, because otherwise you're no different than any other trader that isn't successful, in that you're trading off of belief and hope instead of what's actually going on. As a trend trader, we don't care what direction the market moves in, but we want to make sure we're following the direction. That's the most important part of the process. So if the market is acting and is like it's heading lower, then we want to recognize that possibility and be able to make decisions that'll help us, whether it's, like I said, whether it's not buying as many stocks or tightening up stop losses on trades that we're already in, or selling off some trades to get to a bigger cash position, taking profits off the table. These are all decisions we can make based on analysis of the overall market. And if we're wrong and the market just starts charging forward again, we could always buy back into it. We could always buy new stocks at that time. If we didn't get stopped out of those trades that we had tighter stops on, then we're fine. Those profits increase. If we did take some profits off the table and sell some stocks, we can always buy back into those trends again. Especially if the trend is looking healthy and looks like it could continue to move a lot longer. Now could there be an opportunity cost where we could have made more money had we just stayed in the trades? Yeah, that could be the case sometimes in hindsight when we're looking back. But we could also make the argument if we hadn't made those decisions and the market did sell off in a big way, we could have lost a lot of money, and we'd be looking at that in hindsight as well. That, boy, I wish I would have recognized some of those bearish signals that were flashing before that sell-off took place. So I just want to make sure that because some people they get upset when you start talking about the trend showing signs of weakening, or there could be a sell-off coming. It's almost like they view that as being pessimistic or jinxing the rally, so to speak, or something like that. But it's not. It's just recognizing these signals, and I'm trying to teach these signals to everyone so that you can do the same thing and be able to help in making your own decisions. So going back to the QQQ chart, one thing I've been talking about a lot recently is that I felt like the market. I've said this a couple weeks ago, about a week or so ago, that I felt like the Dow and the S&P were going to break out to new all-time highs, and so far that looks like that's going to happen. At least if the S&P can close at where it's at today at a new all-time high. I felt like the NASDAQ 100 and the Russell 2000 would rally along with it. They'd go up as well, but they wouldn't reach new all-time highs. They're too far away from that breakout area. And what I've talked about over the last week or so is that the possibility that this is forming a bearish ABC pattern here on the NASDAQ and the Russell 2000, where that's wave A. This is wave B. In fact, I even said we could rally up to, I think I said about 330 or so. It was kind of an area. Now, where I got 330 from was just kind of an estimate, but it was basically based off of typically your wave C will complete at about the same point or same length as your wave A. So if wave A was about that distance right there, let me use a highlight tool, a little easier to see it. Wave A move that distance, then wave C should move about the same distance, which put it around that 330 area. It's also right about, you got a little bit of resistance in this area right here, so that kind of lines up with that. So that's kind of where I got that target from. And you can see here's where we are today. We're not that far from that. And with the Dow chart, if we go back to the Dow chart here real quick, looking like it's been moving a little bit sideways and looking like it could still push higher off of this little sideways move. That's where I come up with the belief that maybe Monday we rally again. Remember, markets are closed tomorrow, so there's no trading tomorrow. But Monday, I think that it's possible we can maybe even just open higher. Maybe we gap up. But actually, that'd be a really strong sign that we're ready to sell off, is if we were to gap up on Monday and then close lower than the open. So if we had a red candle where we gapped up and then sold off, didn't have to sell off all the way back down to here, but just close lower than where we opened. That could be a sign that maybe everything's kind of done and we're about ready to start a bigger correction. That would also could push that QQQ chart a little bit closer to that kind of target area that we were looking at. And then who knows, maybe at that point we'll see if it starts to roll over and drop, or again, there's still an outside chance that both the NASDAQ 100 and the Russell 2000 end up charging forward if money flows back into some of those riskier trades and the kind of the risk-on trade takes off again. And you could see it's definitely a possibility. And if that were to happen, you'd see me flip flop from being pretty bearish right now to turning pretty bullish at that point. That'd be a pretty strong signal that things could start charging forward a little bit. And then if we look at the IWM chart, kind of similar, where this is kind of that wave, maybe that wave A would be wave C. Now this one looks like that wave C is already about the same length as wave A. You have this little resistance area up here a little bit higher that maybe it could get up to. A little bit of resistance just below that right to here. And so definitely a little gap up or something on Monday would probably get you pretty close to that. So again, I could be looking at things completely different on Tuesday when we have the next official market update. But that's just kind of what I'm seeing right now. And actually, today's strategy that we're going to learn can help a little bit with recognizing some of those vulnerabilities and how can you use protective puts. You don't want to necessarily look at a situation like this where there's definitely some weaker signals that are showing up, but nothing that's screaming, hey, a sell-off is imminent. So when looking at what I've looked at so far, like I said, I probably wouldn't go out and just sell everything I have. I wouldn't panic like that. Because just could be some momentary weakness. I definitely would consider tightening up stops on trades that I was in, or even taking some profits off the table on stocks that I felt I've had a pretty good run and they're already kind of overbought, so I don't see too much more upside reward potential. But if the market does take off, I could look at stocks that have been beaten up a little bit and take that money out of that trend that's stretched and put it into one that might be starting again. Those are decisions I might make based off of this analysis. And if I did see that gap up on Monday and then it closed lower than the open, I might start to. Again, we still wouldn't know at that point if a sell-off was coming, but I'd start to take a little bit more defensive action, stronger defensive action at that point. Really considering taking profits off the table or buying protective puts on positions I'm in. Maybe even buying puts on stocks I think are going to drop to try to make money on some of the stocks going down. Or buying puts on the whole market like the SPY, the DIA, or the QQQ or something like that, IWM. All right, so that kind of is my outlook here based on where we're at today. Let's take a look at some individual stocks. And I'm gonna probably stay mostly in the oil and energy. This is where I found kind of most of the patterns that looked pretty decent. There's not a lot that I really like as far as the individual charts. Now the performance, again, they're still in trends. They're still in uptrends. But on some of these, I just haven't liked the way they've looked on some of their pullbacks, where some of these look like they can sell off a little bit further. And that kind of ties in to, again, the market analysis. Market analysis is starting to show signs that the trend is the current trend is getting a little weak, might be starting to roll over. And when I go in to look at individual trades, and I don't see a lot that just look fantastic or look really, really excited to get into, then that's usually a warning sign. That's a sign that, hey, the individual stocks are confirming what the indexes are showing me. And to kind of contrast that, if you were to go back and view a market update for a stock-specific class back in November or December in particular, I mean, there were so many trades we were going over in those classes. It was like you could almost pick anything in these lists and they were going to work out because the trend was so strong. There's money flowing in. And so keep that in mind is a little bit of a tip that whenever you're going through these and you're just not seeing a bunch that you like, especially up here near the top, because these are the leadership sectors right now. And if you're not finding great trades until you get down into this lower part of the list there, that could be a little bit of a red flag. Again, doesn't mean that these stocks can't go up or anything like that, but that's usually kind of a red flag to me that I'm not finding trades easily. When you're finding trades easily, that's a really good sign that that you're in a nice strong uptrend. And when you're really trying to desperately find something to trade that looks good, that's usually a warning sign that you're right at the end of the trend, probably at the end of the trend, because you're at that point you're either not wanting to chase the trend because it's up so far. If I'm drawing my stair step, when you get up here to the top of when you can already see that you've had a nice big run up right here. You're probably due for a little bit of a step or a pullback. That's kind of where we're at right now. You don't want to chase stock. I want to buy into a bunch of stocks that looks like I might be. They're in uptrends. They're in strong uptrends, but I might be getting in right when they're about to roll over. Maybe that thing goes up another day or two, then it pulls back. So you don't want to chase into those ones. So those stocks don't look good for new entries, at least. And you don't have, and because you've been in that long upward move, you don't have a lot of stocks that, or even some of the stocks that have pulled back. Sometimes they've pulled back. They've had just an initial pullback. Maybe they're moving a little bit choppy right here, and you're worried about them having another move down. And so they don't look like they're ready yet to want to jump in. They look like they might have one more move down, and so they don't look attractive to get in just yet. So that's kind of what I'm talking about when you go through these lists here. If I look at, for example, computer and technology, or let's look up here at the kind of the retail sector here. If I look at let's look at we can look at computer technology. I'm trying to think. There's a few individual charts. Actually, on this one, on the retail sector, we've talked about Kirtland's before, and actually this one's not too bad, but I didn't like where it started to move sideways right here. I didn't like when it dropped to a lower low right here. Now it did end up, before it did that, it did break out to a higher high right here, but that was, so you had this move up to a higher high and then it went right down to a lower low. Now, since then, it's been kind of in this range here, but that kind of worried me a little bit that maybe, because when I look at sideways moves, I like to see them kind of real sideways. I don't like to see them looking like they're reversing trend. That kind of looked like it was reversing trend because it came right after it broke out to a new high right there. So it could be something as simple as that, where the chart just doesn't look as nice as I'd like to see it. And when that happens, that kind of is a little bit of a red flag for me. But if we go under autos here, and then we'll go under the oil and energy. But I do like the pattern that's kind of forming on Tesla. Although I do want to point out what you'd have to be aware of on this one, because this is similar with a lot of stocks right now, and it's similar with what the overall market is kind of doing. But in the L8 wave class, you already had this big pullback right here, and then we started to move up right here, had a sharp move up, and then since then we're chopping back and forth a little bit as it pulled back, and then it looks like it's starting to take off again. Looks like it's starting to have a sharp move, although it's down a little bit today. And in the L8 wave class, I talked about how that moves in waves. This could be a wave one of the start of a new uptrend. Wave two, this could be wave two, and we could be starting wave three, which tends to be the most powerful wave, which could lead Tesla maybe back to new all-time highs again. However, the other possibility is that this is just the start of the correction, This is a larger wave A of the correction. This is a smaller wave A, wave B, wave C, which could still rally up a little bit further here. And so that could be a bearish ABC pattern that forms wave B, and then you get wave C that brings things all the way back down. Now, if you look at a bigger, longer context of this, like a 1-year chart, you could see that, you've had this big run up. Actually, let's look at a 2-year chart, because that would probably give us a little bit more to look at here. Yeah, so you have this big, huge run up right here. And this could be just the first part of a larger correction, where that's wave A. Again, we could move up a little bit in the near term, where that could be wave B. And then you get a larger move down for wave C. And remember, wave C's tend to be about the same length as wave A. So that would put it down around here. That's also right where you had your last consolidation. So that'd be a target point where you could probably expect it to get to if that were to take place. And then you throw in all other types of analysis where on pullbacks, stocks will tend to retrace about 50% of their moves. So you're going to move up. Usually on a pullback, it'll retrace about half that previous move. That's the rule of thumb. Okay, it doesn't mean that's what it's always going to do, but that would if it did pull back to right here, that would pretty much put it near 50% of that whole move up. Be about the halfway point of this whole big move up that it started to make. So although it's looking like it's starting to move up a little bit in the near term. Oh, by the way, we can go back to that 2-year chart, and it's possible that this is the correction. This is possible that this was the correction, and it could be starting a new uptrend, new 5 waves up. But see, analyzing the chart like that, because I don't know what the ultimate outcome is, but what it does, it helps me recognize possibilities. And so if Tesla runs up to, about that 750 area right here, that'd be about where if this is a bearish ABC pattern, that'd be about where wave C would be about the same length as wave A. And then starts to roll over and starts to drop significantly, where it starts to come back down, then I'm not looking at that saying, oh my goodness, what's going on? How can this be happening? Tesla is Tesla, I drive a Tesla. You can make all these excuses for it to go higher, but having done all that other analysis, you could say, hey, wait a second here, that Jerry talked about how this could be moving all the way back up, but now that's rolling over right here, and it's rolling over right at this spot where that could be a bearish ABC pattern right there. There could be huge downside left in this thing, and think of how much money you would save if you got out of the shares you were in at that point, so they didn't have bigger losses, particularly if you would have bought down here or somewhere a lot further down here, or profit from it dropping. Could you start buying puts on Tesla if it's going to drop down to $450 or something like that? So being able to recognize those possibilities and changes in the probabilities, again, you can start to see how you can really profit from that in making your trade decisions. All right, let's go into the oil and energy sector. One that I talked about on Tuesday, I still like. I think I talked about it on Tuesday, but SUNW, it's a 99 strength rank. Had this pullback right through here, but this is one, and it just went to a buy signal today, but this is one that's similar with Tesla that we just analyzed, that we have to be aware of, that it could be, this is a bottom. It did have kind of a choppy move on the pullback. So it might be wave 1, wave 2, or going into wave 3, but I got to make sure that I recognize that could be just a wave A, the bearish ABC pattern, wave A, wave B, wave C of a bearish ABC pattern, and maybe it heads lower. So even if you did buy in on that buy signal today, It has the characteristics, 98 strength rates. It's come off of a pullback right here. It has some of those characteristics that could mean it could move higher, but now that we've analyzed it, there could be that alternate possibility. If you were to buy in on the buy signal today, and then suddenly, especially if you were to come back down and break below that low right here from a couple of days ago, I'd immediately say, boy, that makes it much more likely that that's a bearish ABC pattern, and this thing's got lower to go, and so I'm going to maybe get out, stop out of the trade, and maybe go see if you buy put options or something on it, or if you want to try to trade it to the downside or something like that. So there's some different possibilities there. All right, another one is CDEV. It's a 98 strength rank. And again, I'm looking at a nice long uptrend right here. Here was an initial sell-off. That might be wave A, wave B, wave C of the pullback. But the other possibility is that this was an intraday high. It didn't close up here, but it did move to a little bit of a higher high right there. Now that can sometimes happen within your ABC patterns. You get wave A, wave B comes all the way back up, maybe goes a little bit higher, then you get wave C, and then it takes off again. And that's why it's possible this is wave A, wave B, wave C. But the alternative possibility is that this was the end of that was the end of the trend. This is just wave A. And notice how we're moving a little bit sideways right here. Maybe that's wave A, wave B, and this has one more move down for wave C. Now that would line up a little bit with Tesla's possible outcome too. And this is in the same sector group. So we'll now this one hasn't gone to a buy signal yet. So this one's a little bit easier to manage, where you could say, well, actually, this is similar. Oh, it's similar to Tesla, and it's similar to SUNW that we just went over. But this one you could be waiting. You could be waiting for it to go to that buy signal anyway as confirmation, and it's not there yet. It's actually has a little ways to go to get there. So I'll be keeping an eye on that to see how that kind of plays out. And then SM right here, SM Energy Company, 98 strength rank. This one looks definitely a lot more corrective through here. So this one looks like although it could be possible that it could be in the same kind of pattern where this is wave A and this is wave B right here that has wave C. But this is a lot more sideways looking, and especially with this not having gone to the buy signal yet, although it's getting pretty close. This would be kind of a tough decision here, because you could just wait on this one to see if it breaks out to a new all-time high right there and buy in on that, because it could move up and go to a buy signal, but it could be still in the sideways range where it could still have one more test down here of these lows before breaking out, especially if the whole sector is doing the same thing. It's hard for me to believe that all the other stocks in the sectors could go into a wave C if that's what their patterns were showing, and then this one's going to break out and just go higher. It would tend to have kind of a similar movement, although with the fact that it's moving a lot more sideways right now, I wouldn't expect this to drop down as far on a pullback, probably down to this area right here, if the rest of those stocks in the sector were to pull back a little bit deeper. So this one looks like it's a little bit stronger trend. Now, I hesitate to say that, because I'll say something like that, and then they'll have an earnings report or something that comes out that was just terrible, and then suddenly the stock gaps all the way down here. I've had that happen before, where I'm like, looks like the stock is looking pretty good, and the buyers are strong, and then they have some event. Usually, it's like an earning announcement, where anything it can happen. An earning announcement, you just don't know, and then it gaps way down, and everyone's like, "Yeah, way to go, genius." And then another one in that sector, I've liked this for a while, but with some of these too, with the risk off kind of trade going on right now, and a lot of the smaller companies kind of stagnant a little bit right now, because there isn't that money was flowing into them in November and December has kind of stopped a little bit. But FCEL is one that I traded back here during this uptrend, and I start strong upward move here. Had this deeper pullback, did go a little bit lower right here. So, I'm wondering if there's a little bit of double bottom right here, a little bit of support. Just barely went back to a hold signal. So you have a little ways to go for this to go back to a buy. But I like this longer term as well. It kind of fits into the alternative energy trade, which is kind of big right now. Again, maybe in the short term there's still a little bit more weakness there, but longer term, I like this company, and it's the trend it's in, the overall trend it's been in, especially after this pullback here. All right, let's switch over into talking about protective puts. It kind of ties into a lot of these discussions here. Now we've got done talking about options for the last several weeks and different ways we can use options. We just got done on Tuesday talking about covered calls. But another way you could use an option strategy, and again, I talked about this when I started talking about options. I said, even if you're just a trader, you just want to trade stocks, this option stuff seems too risky, and yeah, you get into buying options and they expire, and you're spending money to buy those options. It can be a little bit riskier for some people. But I tell anyone that's a trader or investor, that anyone that wants to invest in the long term or build a large stock portfolio, you've got to learn how to trade options to increase your opportunities to make more money and to safely make more money, as we showed with selling puts to acquire your stocks and selling cover calls to bring in extra income while you're waiting for that stock to go up in the long term. But also how to protect that portfolio. And as you're going to see today, whenever I teach protective puts, I always have people, especially that have been trading for a while, trading stocks for a while, that say, "Oh man, I could have saved so much money if I would have known the strategy 3 years ago or 5 years ago," or something like that, or whatever turbulent period they went through. And so that's the benefit, is being, knowing the strategy, whether you use it or not. At least you know about it. You can use it in certain situations. So I'm going to pull up. We've been using BLNK for all the examples. Like you said, we'll just continue to use that as our example here. And the reason why I do this is because when you kind of are still focusing on the same stock for your examples, what I'm trying to show you is the situation. Okay, here's my stock. Here's the stock I own. Here's the chart. What happens if this happens? What happens if this happens? So we originally showed when this stock looked like it could go up off of this pattern right here. I think it was back in this area right here. Showed you how you can sell puts to acquire the stock. Sell the puts. If it's put to you, great. You like the stock. You like the price that it's at. Once you're in that stock, last couple of classes, we talked about how you could sell calls, and we used the example of BLNK on Tuesday of, how you could different ways I could sell calls to bring in income while I'm waiting for this thing to go up. Selling out of the money calls, or why would I sell them in the money call? or different, all those different strategies there, and you can kind of all focus on the same company. Well, now it works out perfectly today where we can talk about protective puts. What if you did buy this stock? I'm going to assume we bought it down here. Sorry about that. Hold on here. So we have this. Where I'm going to assume we bought down here. We bought our stock at. Well, actually, we can do this. We bought on this day, so it started. Had this little pullback, started to move back up. I'm going to assume we bought it at $37. Okay. Had this run up right here, but today it's had a bearish candle. It opened higher. It's looking like it's going to close lower. Now that's kind of significant because it's also a possibility, like the other charts we've been looking at, that this is a bearish ABC pattern and this thing's going to go down. That could be wave A, wave B, wave C. And we're heading, it would be heading lower there. And that's kind of why this works kind of perfect for our example. We don't know yet what it's going to do, but this is what you could do in this situation. So I'm assuming we bought a little bit earlier because we're usually you're buying your protected puts when the stock has kind of been going up, and then you see something that looks bearish. Now, the tough part about deciding on a protected put is that what we're going to do is we're going to buy a put option. Remember, a put option gives us the right to sell the stock at the strike price. So if I bought the stock at 37 right here, I could even go up a little bit right here and say the stock's up here at 43 or whatever, somewhere around there. I could sell a put or buy a put. I got to make sure I'm clear on that. I'm going to buy a put. Let's say I buy the 38 put. What am I buying? I'm buying the right to force the option seller to buy my stock at $38. Or buy stock at $38. Now, in this case, it could be my stock that I'm forcing him to buy. Okay. Now that's going to cost me money though. And so now remember, as an option buyer, I'm buying this put option. I have the right, but not the obligation. So I don't have to force anyone to buy my stock. Okay. But I'm buying, and what I'm hoping for is I buy that put option, let's say for $1 or so. And let's say the stock drops all the way down to $30. I have the right to force the option seller to buy the stock at 38. I could exercise the option if I wanted to. Or that option dropping all the way down to $30, I have the right to force the option seller to buy it at 38. That option would be worth at least $8. I bought it for $1. It's worth now $8. At least. Okay. I could just sell the put. Okay. So you see the difference there. The stock's at 30. I could force them to, well, actually, in this case, I bought it at 37. Okay. But there again, if I'm holding onto the shares, the share value is dropped down to 30. So, that loss right there, I'm making up for that loss by my put option going up in value. Now, important thing to understand is that you're not perfectly going to make up for the loss. Okay. It's not going to be exact. And the way I like to explain that is kind of like an insurance because this is basically I'm buying insurance on my stock. In case the disaster hits and this thing drops in a big way, I'm not going to have the full loss. But if you've ever dealt with an insurance company before, if I if I crash my car and I go to the insurance company, they're not going to pay me or at least they're going to try not to pay me the value of what I bought that car at, because obviously cars depreciate. So if I bought the car for $40,000 3 years ago and I get in a crash and it totals it, they're not going to give me a check for $40,000. They're going to say, well, this thing has gone down in value over 3 years. You've owned it. We think it's worth $30,000, and that's what we're going to give you. So I don't get the full protection for that loss, but I get most of it. That's why we buy that insurance, is we know that it's not going to get, we're definitely not going to come out ahead with the insurance company, but we'll protect the bulk of the loss there. Okay. Now, because we're spending money on that protection, though, we have to factor in, well, what if this is just a one-day move? What if this isn't leading to a bigger move? And what if this thing ends up going higher? Okay. Well, then I spent that $1, and basically, as this stock goes from 40, let's say $43, let's say it's at $43. If it goes up tomorrow and it goes up to 44, guess what? I still get to own my stock, because I don't have to exercise that option. I don't have to force anyone to buy my stock. But that dollar, at least that $1 move from 43 to 44, I don't get, because that dollar was spent buying that put. That cost is gone now. So I don't want to buy a protected put any on just any sort of a down day, right? Because I'm just going to be killing my profits if that stock keeps going higher, and I didn't need the insurance. What I want to buy a protected put for is if I see something imminent, that could be bigger move down, but I don't want to get out of my shares. So I really want to participate in the stock for the long term, because some stocks are going to have deeper pullbacks. They're going to resume those trends. They're going to have those stair steps. I don't want to take a full loss on that pullback and have to wait for it to go back up again. Because if this stock goes from $50 down to $40 and I'm down $10 in value, and it takes 3 months for it to drop and then 3 months for it to go back up to 50, well, here's 6 months out of my that whole 6 months, and I'm back to where I was. Meaning I have I lost 6 months of time, and nothing benefited me from that, except the hope that it continues to go higher. And then, not to mention the fact that this thing really just falls off the cliff, and the whole story changes, where now it drops down to 30, and now I don't like the outlook for the stock and don't want to be in it. I definitely don't want to hold it for the next 10 years waiting for it to go back to where I got in. Well, what if I bought a protective put, and when it dropped down to $40, yes, that lost $10 in value, but with my protective put, again, it's not going to protect it completely, but let's say I gained $8 in value on that drop, or I protected $8. I shouldn't say gained, because you didn't gain, because you already had the gain. You were up here at 50. It dropped down to 40. But on that drop, instead of taking a full $10 loss, I basically took a $2 loss, because that put option went up to $8 on that drop. So now I only have a $2 loss. Well, when this thing starts to go back up again, how long is it going to take me to recover a $2 loss? That might only take a week or two or something, maybe even a day on some stocks. But it's not. And now it goes up to $32, and now I'm back to, as far as my actually that'd be $42. So the $10 pullback here, so it goes up to $42 right here after bottoming out right here. Now I'm basically back to break even. I have the same value as I did up here. So when it goes from 42 back to 50, instead of just getting back to break even again after those 3 months of going up again, I'm up $8. Does that make sense? I'm I'm building value again within my position on that thing rallying back up. So that's kind of why. But like I said, the tough decision is, do I need it? Do I need the insurance? Because you don't want to buy protected puts if you're just expecting a little bit of a little tiny pullback. You know, these are kind of little bearish candles right here, but they're not huge in the context of everything too. They're not huge. They're not saying this thing is going to start dropping in a huge way. And so I might be able to just weather this little pullback right here off of that and have it start going back up again. I don't see a need to buy that protection. Now, why would we think we might need a need here? Well, because we have this sharp move down, and it's possible this is a bearish ABC pattern, wave A, wave B, wave C. And if that is the case, and you're getting a bearish reversal day right there, your wave C, if that is a wave C, it's about the same length as wave A, which is something you'd look for. If all this is lining up, this thing could be a bigger move down. And I'd want to have that protection in place, because let's say it costs me $1 to buy that protection right now. If it does continue to go up and it shakes that off, I'm giving up $1 of my net. I'm giving up the next dollar profit for that protection. And that's, in this scenario, I think that would be worth it. Okay. In fact, even a couple dollars, $2 or something for protection in this scenario for me would be worth it, because there is that potential of a much bigger move down. Now, the other choice you got to try to make is time. We're buying options, so we don't want to buy more time than we need, and it's going to be more expensive to buy more time. So before I buy protected puts, I usually like to see something that's triggering an imminent, could be triggering an imminent move, something that could be happening very soon. I might be a day or two off, but very soon. And then I want to try to estimate how much time I might need after that. Now, one thing that you ought to understand too, is that stocks will tend to fall a lot faster than they rise. It could take you 6 months to build this uptrend right here, and it could take you 3 days to wipe half of it out. It's just the way stocks move. They tend to fall a lot faster than they rise. And so that's good, because if I see a signal that something could be happening imminently, then I don't need a lot of time. I might only need to go out a week or 2 weeks tops, and I don't need to buy a lot of extra time if I think that move is happening very quickly. Now, another thing to consider, though, is the longer you wait, the more expensive it's going to be to buy that put. In other words, let's say I say, I just don't know. That's a bearish reversal signal, but I want to give it one more day just to be sure. Well, you give it one more day and you get a sharp sell-off right here. Not only is now you're going to take that loss. You didn't have your insurance policy in place yet, so you're going to take that loss right there. But you now feel like it could drop a lot further. You want to protect the rest of your position. And actually, if we're buying in on this day right here, basically we just wiped. If we had a big, strong down day, we probably just basically just wiped out our gains. We haven't taken big losses yet, but it looks like it could drop a lot further here. Well, guess what's going to happen to the implied volatility of those options? That option premium, remember the extrinsic value? Remember the analogy of the blowing air in the balloon that's going to expand. That implied volatility is going to go up, and that put option is going to be a little bit more expensive to buy. In other words, what I could have bought for $1 on this day right here, now I wouldn't be able to get the same strike because it's all the way down here, but if I bought the at the money strike down here, it might cost me $1.75. That option might be almost twice as much money to buy now. I still have protection now once I buy it, but it's costing me more. So that's the trick, because it's like, well, do I buy that protection right here? I might be a little bit early, but if I wait, it's going to be a lot more expensive and a lot more damage. And so that's why, again, it's important to really work on your skills of reading price action and charts, because That helps you better make that decision. And like I said, with everything I talked about today, if you go back and talk about the market analysis, remember I said, it looks like maybe we have an up day on Monday, but we could have potentially the market rolling over and selling off early next week, or at least by mid to late next week. So, you know, you combine that with this pattern right here on this chart. It's like, yeah, it'd be worth it. And again, what am I giving up? Well, if I'm wrong, I still own my stock. The stock, let's say this stock makes a big jump and it's up here at $47. Okay, I'm wrong, but it only cost me $1 for that protection. And that first $1 it moved up, I didn't get to make that money. That covered the cost of my protected put. But now it's up a few more dollars than that, and I'm fine. I'm still happy. Still, my shares are going higher. Why would I be upset? All right, so let's look at the option chain here. Now, again, what's kind of important to understand is that in this scenario here is that I'm assuming that I'm assuming we already bought the stock. I'm assuming we bought it back here at 37. So on 100 shares, now that's another important thing too, and this would be a reason why you might want to buy your shares in 100 share increments, or at least get them towards 100 share increments. Is now let's say I only have 50 shares. I can still buy a put. Okay, I can still buy a put, but the put is going to be they're in 100 share increments, and so one contract of the put is going to be for 100 shares. So that'd be like double protection, I guess, because you only had 50 shares, but you're protecting 100 shares basically because of the one contract there. But let's assume that we bought 100 shares, so $3,700 to buy 100 shares. If we bought it at 37, the current price of the stock is up here at 42. So we're assuming it had a run, but it's having this bearish reversal date. So we'll make those assumptions here. So let's go back to our option chain here. All right, so we bought it for 37 a while back, a couple of days ago actually. We bought 100 shares, 3,700. Now we think it could drop. All right, so what I'm going to do is I'm going to look to sell first the 38 put. And usually when remember the stock right now is around 42, somewhere right around there, okay, currently. And usually most people, when they buy protected puts, they're either buying it right at the money or slightly out of the money. Okay. It's going to be cheaper to buy out of the money, but you don't get as much protection. But the reason why I like to go a little bit out of the money is because, remember, I'm trying to protect against the disaster. If it ends up being just a smaller move and then it rebounds, then I'm just going to let that put expire worthless. It's not going to matter to me that it's just all it is it's just taking away from my next dollar of profit that the stock goes up. Okay, so I'd like to go a little bit out of the money, so it's a little bit cheaper, but I'm protected from that disaster. Okay, it has a much bigger move down. All right, so right here we're not. I don't see a 38 strike put right here, and that's because I have this set right now just to show me all the options that are right near the current stock price, that are near the money. and have it show me calls and puts. Well, I'm going to change this because I only need to look at puts, and I'm going to look at, I want to buy an out of the money put, so we'll change that to out of the money. All right, so now I get a longer list here. Now these expire today. In fact, they expire in about an hour, so they're not. I don't need that protection from today. But let's go out a week, because we said it might be next week that we start to see this pullback, and I could go out further than that too. But let's look at the prices here to help make our decision. I could look at the 38 put. So again, we bought the stock at 37. Hopefully I don't have to change the time I change the thing, the drawings go off here. Stock is currently at around 42. And we're going to look to buy the 38 put. Now, the reason why this is out of the money is because the stock's at 42 right now, and we're buying at the 38 put. And I'm just showing where, hypothetically, we bought in. We bought in at 37. So the reason why I might do something like this is I might be willing to give back some of the gains that I've already made. But you know, but if it has that big disastrous loss, you know, I want to be protected on anything above that. Now that's going to be pretty cheap. It's only 85 cents to cover that out next week, or $85. And if I'm wrong and this thing goes up to $43 tomorrow, basically that dollar move covered my almost $1 I spent for that protection. Okay. I could get a little bit closer to, maybe I want to protect the gains I already have. So maybe I look at, you know, the $41 strike put. That's just slightly out of the money, one strike out of the money. It's going to cost me $1.94 or $194 for 1 week. So we're covered here till next Friday. We get that big move down, that put option is going to go up in value, and I could just sell it. Let's say it drops all the way back down to 37. Well, if it went from 40, well, if it went from our strike, the 41 strike right here, down to 37, that put option would have to be worth at least $4 just in intrinsic value. So I could just sell it. I could sell it for $4. I bought it for $1.94, or sell it for $4. And now you say, well, that's great. You made $2 or whatever. Yeah, but I lost it on the value of my stock dropping. But that's the whole point, is I'm bringing in some money to offset that drop. And then I'm hoping that after that, the stock will continue to move back up. Now, what if it's a further drop? What if I have to go out till the next? Well, at that point, I can make a decision to, you know, next Friday, if I feel like it could have more downside, I could make a decision to buy another put out the next week. I'd probably buy it out of the money. So if it's all the way down back down to $37 here, if I still think it's going to drop further, I could buy the 36 put out till the week after that. And that's the great thing about these weekly options, is you can just make these decisions kind of week to week. So you don't have to go out, you know, 2 months or something, or a month, even just a month on a pullback you think could be over in you know, 3 or 4 days or something like that. Because remember, stocks tend to fall a lot faster than they rise. Now, with that, if I did spend that $1.94 or $2 and it doesn't drop, well, then when this stock goes from 42 to basically 44, if it keeps going higher, I don't get to profit from that move, but I can anything higher than that. But I've already spent that $2 of that move to buy that protection. So you say, well, why would you even think about the 38 put then? Well, I mean, it's going to be cheaper, and if you get a really big drop, that has potential to really go up in value, and you know, it's not going to protect you as much from the gains you've already made there, but it'll at least offset that drop. Anything below 38, it'll help with that drop below 38. And like I said, it's a little bit cheaper there. So you kind of have to weigh that. Well, it's like any insurance policy. How much coverage do you want? You know, I don't know about you guys, but I go through my policy and say, do I really need that much protection? Because I'm paying a lot more. I'm paying double for this little bit extra protection here. Is it really worth it? You know, that's kind of the decision you're making here. Do I need really want a lot of protection, or just a little bit of protection? But that's how a protected put works, and that's the philosophy behind it. Is that you remember when I talked about that when you have that pullback, that you're not having to wait for it to go all the way back just to get back to break even again, just to get back the gains that you already have. This thing dropped from 50 to 40. I can recognize when these bigger pullbacks are happening and at least protect some of that move, then I'm back to making money again when this thing starts to go back up. I don't have to wait for it to go all the way back up. All right. Gotta wrap things up. I actually went all the full hour. Hopefully that makes sense though, and like anything, practice it a little bit. Do it on paper. Do a hypothetical. You do a hypothetical example of this one. Watch it over the next week and say just write down that you assume you bought in at 37, 100 shares, bought the April 9th expiration, 41 put or whatever we decided there, and just if it drops, see how much that put option goes up in value versus where you bought your shares, and you kind of just see how that would have protected you. Or if it goes higher, we're higher next week, you can see how, okay, I lost that money because I don't get it back. I bought that put. Doesn't have any value anymore. But you know, the stock went up far enough over the week that I made up for that loss pretty quickly. All right, thanks everyone. Have a good week, and we'll see you on Tuesday for the next market update. Bye now.